Hello everyone, welcome to Federal Taxation 2. My name is Professor De Silva. I'm going to be your instructor for this whole semester. Only 8 weeks, but remember we got a lot to cover, a lot of materials to cover in this short period of time. So I might go a little faster. Okay, at least you can cover 2 chapters a day. It's not bad though. You got time. It's just not like you're meeting in a certain time, certain days. But since this is an online course, but originally I was planning to have Thursdays, like 5 to 9 online, means like a Blackboard type of live session. But since some of you have some issues with the timing, so I decided to go fully online so everybody has time to look at or to watch the video that I'm going to put together. Usually I do 2 chapters a week, so you have time. You can watch it anytime you want during that time, during the week. And I'm going to also put together some questionnaire, or not questionnaire, so some few problems at the end of each chapter. So you can practice those and you can get ready for the exam. Within a couple of weeks you're going to have a midterm exam. Okay, so it's keep that in mind. So this is not a full blown semester for 3 months, but just only 8 weeks. So you got to have work a little harder. Okay, let's get into the syllabus first and then go to the material. Okay, here's the syllabus. I'm going to put here very only the important information here. You have a copy of March syllabus, and also Blackboard has some kind of a syllabus. This common syllabus, they put it up there. I just follow my syllabus. I'm going to send it over to you in an email probably. I think I did send you, but I will send you again. The syllabus has all the information you need. What we're going to do each week. Okay, so you have everything. You have my information. If you need to contact me, you can send me an email or put a message in Blackboard. Sometimes I get into email quicker. Okay, so as I said, the time, the meeting day and time is usually it's a Thursdays. I'm going to post these videos, at least 2 videos in a week. Okay, two chapters, the covering 2 chapters. So we have enough time to cover all the chapters that we need to cover during this short period of time. I expect you to work a little harder again, right? So you got to learn. The purpose of this course is to learn certain the tax issues. Let's say again, in this course, the tax 2, the federal tax 2, is mainly focused on corporations, not individuals. Even though the first couple of chapters we're going to talk introductions, we might talk about some individual type of issues, but the majority of the time you're going to you're going to devote to discussing corporate taxes. Okay, to those of you who are not know me, IRS agent. So I mainly handle international cases, the multi-billion-dollar corporations, especially special agent with international issues. Okay, so that doesn't mean that I'm going to help you with your tax issues. We're going to discuss the tax course, but if you have an individual, I can answer questions if you have it. If you have any specific questions, just send me. Probably I can help you with that stuff. Some information. Okay. All right. Let's go to the next part. So the next important part of the syllabus is your course materials, the textbooks that you're supposed to have. Especially, it's important that I'm going to assign the problems from the textbook. You might get it probably electronic version of the textbook. It doesn't matter which way it is, which one it is, as long as you have access to the textbooks. That always matters. Okay, the grading also is very important, and you can see we have a project. We got Form 1120. We're going to work on that. Three cases here. Form 1120, Form 1065, and 1120S, which is, we get into that later. Form 1120 is the corporation. 1065 is for the partnerships, and 1120S is a small corporation. Okay, that projects is about 300 points worth, 30% of your total grades. And then we have a discussion forum postings. So I'm going to put certain topics to discuss in Blackboard. You are required to respond to the certain any posting, any assignments that I put in there as well. Okay, and then we have two exams, midterm and final, 300 point each, which total 1,000 points. That's for your total your course. Okay, 1,000 points, which is equal to an A. Okay, you know the grading criteria. Not getting into too much, but still, well, that information is on your syllabus. All right, let's get into the materials. Okay, the chapter 1 talks about an introduction to tax. This is the textbook that we're going to be using. McGraw-Hill's Essential of Federal Taxes in 2021. So yeah, especially I think this has all the new tax rules or the laws that 2017 they put out. So this is important that 2020, when we're done with the course, you should be able to file your own tax. Actually, this is corporations. I'm not sure how many of you are already working in a tax area, but it is important to know this type of information. Okay, let's get into the next page, next slide. Okay, the learning objectives. Demonstrate how taxes influence basic business, investments, personal and political decisions. So we get into that to go at least in some detail. Okay, then you got to discuss what constitutes tax and the general objectives of taxation. Describe the different tax rate structures and calculate the tax. Identify the various federal, state, and local taxes. And then we have apply appropriate criteria to evaluate alternative tax systems. Which means now people are talking about, okay, this is too complex what we have currently, especially with respect to the federal taxes, income taxes. So they said they're talking about what kind of alternative tax system we should have, flat tax system, whatever it is. So those type we're going to look at what information do you need to make a different type of tax system. What's the characteristics of the tax system? That's what we're going to learn in this chapter. Okay, who cares about taxes? Literally, sometimes some people might say, who cares, right? That's not literally here means. Okay, we do care about taxes. These are the people who cares about taxes. Businesses. Why? What organizational form should a business use? Now, what does that mean? When it comes to a business, if you're going to set up a business, if you're going to open up a business, you got to think about tax consequences, tax impact on your business. Now, if you are, say, sole proprietor, what kind of business you going to use? Is it a sole proprietor, the partnership, or the corporation, or a small corporation, whatnot? The different type of business has a different type of tax implications on your bottom line. Okay, we'll get into that. We can discuss this probably later chapters. You're going to get into more detail. So what type of business going to use, whether it's starting up a business or in so what type of tax implications you might see depending on your situations or other situations. Okay, so for now, let's see, where should the business locate? Sometimes, depending on the area the business locate, some states give you a tax break. So you got to make sure that your business is located in some certain areas. So it's not just state. Why the business is moving out of the United States to foreign countries? Think about that. Some foreign countries charge no tax. Some do, but it's very small. The tax rates are very small compared to US. So they move their businesses. This location is important. How should a business acquisitions be structured? Depending on if you are acquiring a business, how should you plan to acquire a business? What is the least amount of tax I should pay by doing so? The certain people, they are exporting, putting these type of transactions together. Especially looking at tax. Tax is a huge burden on businesses as well as the corporations, individuals, and anybody. So that is very important that you structure it such a way that you minimize your taxes legally. I'm not talking about illegal type of things people do, but it's legally. How should you organize and structure? Okay. How should the business compensate employees, paying salaries, whatnot? What is the appropriate mix of debt and equity for the business? What does that mean? When you talk about accounting, I think it's intermediate 2 or 1, they talk about debt and equity in a corporation. The debt is the borrowed money, the equity, the capital, right? So when you have a capital, you cannot really, what do you pay? When you borrow money, you pay interest. When you pay interest, it's deductible. Okay, for tax purposes. So that means, suppose you have before interest, you have 100,000 income before interest. If you are paying interest $50,000, so you can deduct that 50,000 to arrive at the taxable income of 50,000. But if you have equity, instead of 100,000 debt, your capital, so there is no deductions. You pay dividend if you have profits, you pay dividend, but dividend is not deductible. So those are the things that you consider. Okay, what is the mix? You cannot really have only debt or only equity, but you have a mix. You can see that why it's appropriate to have a mix. Appropriate mix. That means a certain amount of debt and a certain amount of equity gives you a maximum profitability of a business. Should the business rent or own its equipment and property? So what does that mean? If you rent, if you lease, so rent is deductible. If you lease, the lease payment is deductible. But if you own your own equipment, it's no lease or rental, but you can deduct a certain amount, what do you call depreciation. Okay, you got to think about that as well. What's the best option to have? Depending on your business, how should the business distribute profits to its owners? Okay, we got to look at that as well. That's the tax point. You know, if you distribute your earnings, the profits, in a way of, if it's a regular corporation, you pay dividend. If it's a partnership, if it's a small corporation, the distributions consider income to you. You have a report in 1040. Again, regardless of you, if we get into that a little later, but if it's a corporation, only you have to pick up your dividend if the corporation pays dividend. In 1040, you report dividend. Dividend is taxable at a lower rate. But if you have a partnership, a small corporation, regardless of you whether you distribute or not, you have to include your portion of your income in your 1040 when you file your tax return and pay at a regular rate. Okay, that's a very good information to know before you decide what kind of business you're going to operate, right? Because of the tax implications. Okay, the second type of people who cares about taxes are politicians. You know, politicians talk about taxes every day. That's their the major topics when they run for office, right? I'm going to cut taxes by this much, all kind of stuff. That's one of the major things they talk about. Politicians often distinguish themselves from their opponent based on their tax rhetorics. The voters, they must have basic knowledge of taxes to evaluate the merit of alternative tax proposals. Suppose they say, I'm going to cut taxes by 10% or whatever it is. That's what they say. I'm going to increase taxes for rich people. Those type of things. So the regular folks like you and I supposed to know what exactly they're talking about. What's the bottom line? What is in it for me? Right? So that kind of things. Okay, that's the second people who cares about taxes. Okay, here comes us, the individuals. We care about taxes than anybody else, right? Even for various reasons. If you buy a home, you got to think about, okay, is it taxable? My property taxes going to be deductible? Is my mortgage interest going to be deductible? Before that 2017 tax rule changes, we were able to deduct the entire property tax, regardless of amount. Now, 2017, they put a limitation on as to how much you can deduct, 10,000. So if you have two homes, you basically, you're not allowed to deduct anything over 10,000. So especially the state like New Jersey and New York and East Coast area and the other side of the other side, which is California and that area also, it's a very high property taxes. 10,000 is maybe like half of what you pay property taxes to certain homes. But that's an important thing to think about. Okay, and here's like to retire. Would you like to retire? This is understanding the tax advantage methods of saving for retirement can increase after tax value of the retirement next X. What does that mean? So sometimes when you have retirement options, this before tax can save for retirement, can increase the after tax value of your retirement net X. Let's get into what else we got. What qualifies as a tax? We talk about tax and all kind of payments we make to the governments, local governments, federal government, state or whatnot. But what is tax? What is a tax? A tax is a payment required by a government that is unrelated to any specific benefit or service received from the government. So when we pay taxes, are you expecting anything in return? Especially the taxes that we pay to federal government. You don't get a direct benefit from your taxes you pay. Okay, key component of tax: payment is required. Payment imposed by the government agency, it's a federal, state, or local. Payment not tied directly to benefit received by the taxpayer. We know that, right? So, as I said, it is not going to benefit directly. We are not going to benefit from the taxes we pay directly. Maybe indirectly, some way or another, but not directly. Okay. Let's go to the next one. Okay, we got a tax question here. Let's see what we have. We got, which of the following constitute a tax? What do you think? Which one are these? It says payment for driver's license. It is not a tax. If you are paying for your license, okay? It is not a tax. Let me put this color here. No, it's not a tax. Payment for required house appraisal. No, that's you, right? So it's benefit you, it's no tax. It's not a tax. Payment for hotel use or 1% of bill to pay for city project. So that's a tax, the city tax. Yes, right? And then a payment for rental car use of 3% of bill to pay for the roads. Yeah, that's also considered a tax. It can be local tax. It is not in income tax, but it is a kind of tax that we consider is a tax. Now we learn a little bit about taxes. Again, this is just the introductory chapter. We go through these things, and later on we're going to dig deeper and go into details. To calculate a tax, how to calculate a tax? To calculate tax, the taxpayer must know a couple of things. Tax rate. What is my tax rate? Especially when you talk about income taxes. Level of taxes imposed on tax base, usually expressed as a percentage. Say it's 20%. It's not the same. It's not a flat rate at 20%. When we get into that, we'll explain what it is. 20% for certain amount of taxable income. Then after that, it's a different rate. Okay, we'll get into that probably later slides. Tax base. What is a tax base? It's actually taxed. Is actually taxed and is usually expressed in monetary terms. Tax base is your taxable income in dollar terms. That's what's in monetary terms. Okay, say 100,000. You have a taxable income 100,000. You pay. Okay, just put the numbers here. Tax base is 100. Okay, if you have 100,000, tax rate is 20%. Okay, what do you get? You got 20,000 of tax. That's simple. How to calculate taxes? Very simple. If you know the tax rates, if you know the base, it's easy to compute. Okay, we're going to look at different ways to measure tax rates. Something called marginal tax rates. Marginal tax rate is the tax rate that applies to next additional increment of the taxpayer's taxable income. Suppose you had a taxable income of 100,000, and then you have extra, something else added. So another 50,000 came as extra tax. So for this amount, you got 20%, and for extra 50,000, maybe a different rate, say 25. So that's going to be the marginal rate. How to compute a marginal rate? Marginal rate, you compute change in tax, the taxable income. So what is the total tax you pay, and what's the change? It's just a change in tax divided by change in taxable income. You get a percentage. It's a percentage. Marginal tax rate is a percentage. Okay? Simply, what is your new tax minus the old tax? So new tax is, say, with 50,000 extra, there's total 150,000. You're paying 25,000. Say 25,000 of taxes. So old tax is 20,000. New tax is 25. So 25 minus 20 is 5,000 extra, and your change in taxable income is 50,000 from 100 to 150. So that's how you're going to calculate the marginal. We put the numbers and see how easy it is to compute. Average tax rate, the taxpayer's average level of taxation on each dollar of taxable income. Taxable income. Okay, what is the tax? Total tax divided by taxable income gives you an average tax rate. Even though you may have progressive tax, first 100,000 20%, next 100,000 35%, so on and so forth. But if you look at everything together, okay, total tax. Total taxes divided by total income, total taxable income gives you an average tax rate. Effective tax rate usually is the taxpayer's average rate for taxation on each dollar total income, not taxable income, but total income. Okay, that's the difference also. Again, we got to put the numbers and see how that works. Okay, here's a quick example. Let's take a look at this example, tax rates example. Bill and Kate have 160,000 of taxable income, an additional 10,000 of non-taxable income. She got 160 taxable income. There's non-taxable income on 10,000. What is non-taxable income? Sometimes you have bonds, municipal bonds, and so forth. If you have interest on those bonds, This usually is not taxable. So that's the non-taxable income. So using 2020 married filing jointly tax rates, what is their tax due, average tax rate, and effective tax rate? Okay, you got to compute three things over here. Tax due, how much the tax? Now, what is the average tax rate? And what is the effective tax rate? And if they received an additional 80,000 of taxable income, what is their marginal tax rate on this income? So you got to compute four things. Okay, let's do that. Okay, the tax computation. You get a tax due 26,780, but how did you get that? So that's the question. Now, if you look at 2020 tax brackets, tax table, you will see, I think it's the first 19,750. First 19,750 is 10%, which is 19,000. First 19,000. 19. You can't write that well. Let me see here. 19,750 is 10%, which is 19. Let's put the number here. 1970, right? 1970. Let's 1970. That's the first 19,750. Then the next up to 82,750. You gotta look now. 80,250. Between 19,751 and 80,250, you have to pay 12%. So that gives me 60,000. If you deduct, take 80,250 minus the 19,750 you already computed, gives you 60,200 or something, right? So that times 12% gives me, I think it's 7,260. That's what I have, 7,260. Okay, so that's up to 80,250. So anything over up to 160, that's what they have, is 22%. So what I'm going to do, we take these two numbers. What is these two numbers? This is 75, right? 75. So these two numbers together, we get 9235. We get 9235 plus 22% of the difference between 160 is the salary income minus this charges up to here, which is, let me put the numbers here the easy way. Now we know the numbers. Let me erase this and put a proper numbers so that you get an idea. You have an idea what we compute here. Okay, you get, let me put this 70, that's 9235. That's what we got, 9235. That's the first up to $80,200. So what you have to do, this plus 22% of the remainder, which is, we total is 160,000 minus 80,250. That's what this tax is all about, right? So this, the difference between 160 and this one gives me about 78,000, rather 79,800 or something, right? So take that times 22 gives you this number. You get 26,780. 26,780. You can do your math. You can see how that works out. Okay. If you still don't understand, let me know. You can go again. Now, how is the average tax rate is computed? Average tax rate computed is simply you take the total income, taxable income, divided by total tax. What's the taxable income? Taxable income is 160, right? 60. You got you paid 26,780. Come on, This thing's not working properly. 76,780 divided by your total income, which is 160, taxable income. Okay, taxable income. Remember, you get taxable income 160 and non-taxable income 10,000. So this is only taxable income. Gives me 16%, 16.74%. Okay. Now, what is effective tax rate? Effective tax rate, you take the entire revenue, entire income, 160 plus another 10,000 as non-taxable. You total those, you add all these together. Now it's 170,000. You're paying 26,780 divided by total 170. 170,000 of your total income. Okay, total income gives me 15.75%. The marginal rate is the difference. Remember, the marginal rate is increased taxes. So if you look at, now again, you have to compute your taxes. Total tax for with 80,000, this extra income coming in, do the same way, same process, but you got to compute the tax, use the tax table to come up with. So marginal rate is your total tax now is 45,759. What I have 759. Okay, that's the total minus what we have here before this extra 80,000. That's 26,780, right? So that's the difference. Divide by what? Divide by the change, right? 80,000, I think simply it's 80,000. 240, the total count with 80,000 minus the 160,000 original amount, we get 80,000. So that gives me new tax rate, marginal tax rate of 23%, 23.72%, which means you increase $80,000 of increased income are subject to 23.72% tax rate. That's all. That's how you compute a tax. Okay, you're going to get few examples, few problems to work on your own. Okay, so very important that you know how to compute your taxes given the tax table. Whether you are an individual filing single as a single taxpayer or married filing joint or head of household, there's a different rates applies. Okay, keep that in mind. Okay, we look at now tax rate structures. Proportional tax rate, or what we call PLAT rate, PLAT tax, imposes constant tax rate throughout the tax base. Usually it's flat rate regardless of your income. It's income or expense, whatever it is, right? So what's the example of this kind of taxes, this kind of income or expense? Sales tax. Sales tax is an example for the proportional tax rate. It doesn't change. Rate doesn't change. You buy $50,000 worth of items, still 7% sales tax. If you buy 120,000, still 7% sales tax. Okay, tax base is increases, but the rate doesn't increases. Okay, so that's a very good example of this kind of taxes, proportional taxes. Okay. Then we have progressive tax rate, imposes an increasing marginal tax rate as the tax base increases. Usually we see that tax example, that's how the progressive tax rate applies. An individual income increases, so does the tax rate. Okay, when you have a higher income, you have a higher tax rates. The lower income earners get a lower tax rate. That's the progressive tax rates. Regressive tax rate is the opposite, going the other way. Imposes the decreasing marginal rate as it increases the tax base, as the tax base increases. Okay, so what does that mean? What kind of example? Or maybe the social security taxes or unemployment taxes. You are taxed sometimes there's a ceiling that the social security is going to be taxed at. It's 134,000. If you're making more than that, there's no tax. So same kind of thing. Okay, unemployment taxes, employ that kind of a tax structure. If you look at in this graph, visualize this thing. So how would a chart look that maps out the three different tax structures? So you can see if you have a proportional, which means same tax rate doesn't change, whether it's a low tax base or high tax base, this is the proportional tax rate going to remain the same, 20%. If you have progressive, low has a low tax rate, and when it increases, have a higher tax rate at when you make more money. High tax base means high tax rate. Regressive going the other way. Okay, if you're low, let's say starting 30%. If you're high income or high expense, either way, you got a lower tax rate. Tax rate is lower. Okay, just looking at your visualize how that works. Now you're looking at type of taxes. We know the payroll taxes, especially income tax, employment and unemployment taxes. In the employment tax is simply like a social security taxes. So what if you're not social security pay if you are a salaried employee, you work for a corporation or whatnot, work for an employer. So what if you are self-employed? Self-employed employment tax is now about 6.75%. That's the social security tax and Medicare tax together, about 7% or something. So you have to pay both. Now, employment tax, employee pays half and employer contributes the other half. So it's total about 15%. But if you are a self-employed person, you're required to pay both taxes together. Okay, so excise taxes imposed on a certain product, only certain products, so like tobacco product, gasoline, or any type of the different type of product only. Okay, and what is transfer taxes? When you have a transfer tax, that means inheritance taxes, those kind of things. Okay, so you move, this is a trust and state type of taxes. When you transfer your ownership to somebody else, the gift tax, those kind of things. State and local taxes include, again, income tax, sales and use tax, property tax is the highest in the nation. Here is New Jersey and New York area. And excise tax, again, the similar. Okay, the sales and use tax, usually the sales tax is imposed when you buy a product, a certain product, not food are not taxable, and cloth in New Jersey is not taxable. There's no sales tax on cloth or food. How about use tax? What is a use tax? Now, use tax, suppose, especially now, this age of online business, we tend to buy a lot of stuff from out of states, right? And they deliver those goods to us to use in this state, in New Jersey. If you're living in New Jersey, that's where it's going to be used. So since you're not buying it within the state jurisdiction, there's no sales tax, state sales tax. But since the other way they're going to tax you or discourage you to buying from outside other states is hit with use tax. So even if you're buying from outside other states, you still have to pay sales tax. They're going to charge a sales tax because you're going to use it in this state. That's how you're going to pay sales and use tax. Okay, property tax, you know, if you own a property, tangible, intangible properties is still you have to pay. Excise tax, the similar type of product or services you have to pay tax on. And then what do you call implicit taxes? Implicit tax is, let's go to the next slide to say what exactly it is. Well, we'll go over this one a little bit in detail. It says income taxes represent approximately 56.5% of all tax revenue collected in the United States. Individual paid 47%, while corporations pay only 9%. Imagine that. Corporations pay very small amount compared to individual. Okay, leave it on individuals, corporations, state, and trust income taxes. Okay. Employment and unemployment taxes, as I said, it's the second largest group of taxes imposed by the US government. Employment taxes include the Social Security tax and the Medicare tax. Unemployment tax fund temporary, usually paid by the employer. They benefit individuals when they lost their jobs for temporary. Okay. So this is the type of taxes. Let's go to the next slide. Again, we're looking at excise taxes, the third largest group of taxes imposed by the US government, levied on the quantity of products sold. Especially, again, we're talking about the alcohol, the gasoline, tobacco product, and the services like airline tickets they charge a tax, and the telephone usage they tax, excise tax, those type of things. And then we have estate and gift taxes. That's they're going to charge the levy on the fair market value of wealth transfer. This is a transfer tax upon death or by gift. If you give taxes, usually you're allowed to transfer a certain amount of money as a gift to an individual per year without taxes, without paying taxes. But if it's increasing over that amount, you have to pay tax. Here's state and local taxes. Consist of sales and use tax. As I said, the base is the sales tax is retail sales of goods and some services. The tax base for the use tax is the retail price of goods owned, possessed, or consumed within the state that were not purchased within the state. That means the use tax. So remember that, as I said, even if you're not buying within the state usually charge the sales tax. But if you're buying from outside, still you have to pay tax because you're going to use it in the state. Property tax, we know what they are. Property tax are ad valorem taxes, meaning that the tax base reach fair market value of the property. So depending on how much value the property is, they're going to charge the value of the property and then charge a tax as a percentage. The real property tax consists of taxes on structures permanently attached to land. Personal property also, there's a taxable personal properties. As you mentioned before, this state also going to charge income tax. Some local also going to charge income tax, like New York. They has the different counties, different locals charge income tax also. Most state taxable income calculation largely conform to federal taxable income calculations. The limited number of modifications. Now, when we put together your tax returns, you know, your federal tax return, usually they transfer the same information to state, but state gives you, got to make some modifications. They're not allow certain deductions. They allow additional deductions depending on the situation. We did discuss about excise taxes. It's the same. State typically enforce excise taxes on items subject to federal excise tax. It's the same type of product they're going to tax. Okay, I did mention that we're going to get back to the implicit taxes. What exactly it is? It's the indirect tax that results from a tax advantage the government grants to certain transactions. To give you quick examples, this is type of things. You're going to get a benefit of untaxed items like bonds. So if you are owning a municipal bond, if you're making money, interest income is not taxable. If you own a municipal bond, say $1 million bond, they pay 5%. You're making $50,000. That $50,000 is not taxable because the nature of the bonds is a municipal bond. Interest is not taxable. So for that reason, people tend to pay a little more money to buy the municipal bond than it is to buying other type of bonds that are usually the interest is taxable. Okay, keep that in mind. That's the implicit type of tax. Okay, again, if you are going to look for an alternative tax system, evaluating an alternative tax, regardless, yes, if you're putting together a tax system, what that tax system should look like, what it should consist of, what is the characteristics of that system. The sufficiency involved assessing the aggregate size of the tax revenues that must be generated and making sure that the tax system provides these revenues. What does that mean? Now, yeah, you might say, now current system is no good, you're going to put a new system. Okay, current system generated, say, $3 trillion of taxes. That's a good amount for the expenses that we have in the United States. But if you're going for a new system that doesn't generate that much of income, so is that system going to work? No, that's what it means. You have to sufficient. You come up with the system that is sufficient enough to generate the taxes. Okay, the flat tax system might not work, or it works depending on the situation. Okay, equity, how the tax burden should be distributed across taxpayers. So again, like a flat tax system, say all across, we charge 20% tax on everybody. Is it equitable? Is good? Is reasonable? No, not really. You know, there's some people who can afford. So if you're making only $30,000, 20% of that is a huge amount of money. If somebody makes $3 million, it's not a big of a deal. So 20% is 20%. But as far as the tax ability to pay is not there for the people who make low, or people who have low income. So that's what it means, equity. Certainty, the taxpayer should be able to determine when to pay, where to pay, and how to determine the tax. Current system, we know. April 15th comes, you got to pay, you file your tax and pay. You know where to pay, right? And how to determine the taxes. We have established system here. But if you're coming with a new one, you can make sure that you have all these characteristics. Convenience, tax system should be designed to be collected without undue hardship to taxpayers. It's important. This should minimize the complications, the administrative costs associated with compliance. Actually, they minimize the compliance and administrative costs associated with the system. So what does that mean? Now, current system, maybe if you have a good system, it has a higher expense too. If you're going to put a lousy system, flat rate, okay, we said, okay, you're going to charge a flat rate. But you might not have that cost, there's no high cost to implementing compliance type of things or administrative that type of system. But it is reasonable, it is equitable. No, that's the thing that you have to think about. Okay, economic wise, it's not good to have a system that doesn't have these type of characteristics. Okay, we're talking about sufficiency again in detail. The type of revenue forecasting, static forecasting that ignores how taxpayers might alter their activities in response to a tax law change, and instead bases projected tax revenue on the existing state of transaction. That means, all right, I'm going to increase tax by 10% or decrease tax by 10%. We think doing so, we're going to have the same amount of income, which is not correct. So that's why we just ignore the results. When you forecast, we say that we're going to get $100 million or $1 trillion. But if you change the rules, reducing taxes or increasing taxes, probably might not get to that amount. Okay? But if you're using a dynamic, the forecasting that tries to predict possible responses by taxpayers to new tax laws. Okay, what's going to happen when I change the tax law? How the people going to react to the new tax law? Okay, how that income going to be affected? Okay, that's what as dynamic type of forecasting means. Okay, we did talk about equity, but in general terms, the tax system is considered fair and equitable if the tax is based on taxpayers' ability to pay. Remember that we said that, okay, if you make enough money to pay, you can pay. But if you don't have, if you're a low income earner, you might not be able to pay taxes that you're going to charge, right? Horizontal equity means the two taxpayers in the similar situation pay the same tax. Vertical equity is the taxpayers with the great ability to pay tax, pay more tax relative to taxpayers with a less ability to pay tax, right? You understand? The low income earners pay less tax, the tax rate is lower. The high income earners, that's what equity is all about. Okay, we are done with the chapter 1. We're getting into chapter 2 in another video, so we should be able to upload it both at the same time. So let's go to the chapter 2 in the next video. So I'm going to put together some problems too at the end of the chapter 2 so that you can work on. I'm pretty sure there's some stuff on the blackboard is already. If you work on both, it's good. Okay, so remember what I assign you, your grade, your final grades is based on what I'm telling you to do. Okay, keep that in mind. But I want you to work on stuff on the blackboard too. There's certain stuff that I assign there as well.